I'm pushing it out to everybody I can think of because honestly, it is a conversation that is become very near and dear to my heart personally. Like I said, I don't care. Get you, whatever your budget can afford, but let's get something. Because if you need care, your loved ones are going to be so thankful that you put something in place.
Hello and welcome to the Durham Talents channel. My name is Jesse Durham. I'm back in conversation with my friend Miss Robin about long-term care. We talked in general about the need for long-term care and the problem that it presents to folks as an eroder to wealth, let alone the lifestyle that they want to have. We're picking back up where we left off. I hope that you enjoy. Awesome. All right, Miss Robin, nice to be back sitting down talking about what people can do to provide for the lifestyle that they're wanting in life. How are you today?
I'm doing good. It's a busy day, but it's the day before a nice long holiday break, so I'm good.
That's right. That's right. We're coming up on July 4th, Independence Day. Lots to be thankful for and celebrate, right?
Amen. Yes.
Fantastic. Well, if I could recap where we left off in talking about the problem of long term care, it's a need in and of itself. But of course, we are talking very often with folks about implementing infinite banking. So that means that long term care, if not accounted for, can be a great eroder to their wealth, their legacy, things that they were putting in motion for its own ends. So they affect each other. So we talked about that problem. I mentioned Nelson's principles make sense to apply when considering long-term care. Okay, if we're thinking long range, capitalizing, being honest bankers, etc., then long-term care seems to make sense to me. It's better to plan for proactively than in the moment of duress, I believe we decided. And then there is a product out there that is specifically designed for long-term care. We talked about the two main types: a traditional type, which is it has a provision in the event of, if that happens, okay, you've paid premiums in that type of a contract, and then there will be service because of that. There will be cash flow because of that, right? And then there's this other type that's asset-based, which is using the chassis of a whole life policy. It's going to have a death benefit. And we talked about some of those features. I'm going to have some nuts and bolts questions. But is there anything that you feel like we should address on the outset right here?
Well, I think for for me, the first thing that comes to my mind is that, we all have to embrace that we are aging and that as much as I would love to, stay in my 40s, 50s, 60s, the reality is, time is moving and eventually, Lord willing, I will see 70, 80, 90 years old. And it comes down to the question, I think that's where it first, in my mind, starts is if you need care. I think that's if you're going to need care, can that be a possibility and part of one's reality? That yes, there's a possibility somewhere down the road I may need care. And I think that's, to me, it starts there. Before I can even embrace any particular or even talk about long-term care or even embrace any particular company and their product, it starts with the mindset, of recognizing and realizing that you know, I'm 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 getting older, and as I get older, I might need help. And when that time comes, what is that going to look like for me?
And those around us, right? If those around us need, because there's that context too. And you gave a great personal perspective last time. Not to cut you off, please keep going.
No, no, you're absolutely right. That's another thing that I realize, number one, if we start to think about and embrace the fact that, hey, I am getting older. I potentially may need assistance at some point in my life. What is that going to look like? And it can't be a selfish perspective, because you're absolutely right. It's going to affect the people around me. I'm aging, but as I'm aging, I'm going to lean on or maybe need to depend on others. And when I lean on or depend on others, it is going to impact their lives in some way, shape, or form. And there's just no way that they're going to be able to absorb, my needs and not have to make some sacrifices on their own. So I can't even look at this from a selfish perspective. I have to look at this comprehensively and holistically, including everyone that is in my circle or in my life, and to me, that's where it starts, is just recognizing that that's a reality and you can't stop it. You can't stop aging. Nobody's come up with the secret of locking in and locking in your current age. So it's how, and that's where I go back to what we talked about before. That's where the planning piece of it comes in. We need to plan out the future that, ideally that we would want.
Absolutely. And if I could repeat something that we said last time, it would be the idea of living as if we're going to live forever, but planning as if we will die today, tomorrow, right? That old saying. And I'll say this too, Miss Robin, there are so many different angles on this conversation of long term care, because we could be talking about people taking positive steps towards providing for their own needs. We could be talking to people who are looking to procure something for their grandparents or parents. So there are so many different angles. The grandparents or grandparents may be wanting to get something for themselves. So all these family dynamics.
It is, you bring up a good point. That's why I said last time, it has to be a family affair. It's not just you have to include the kids and, might possibly the grandkids, or the people, around you. They have a vested interest in the future that we can plan, now for you, so that there's less of an impact upon me or and my family later. So I really do believe it is a whole family affair, and if you can if you have that type of a family and you can get people to the table and start to have these discussions, I think one can carve out, a future that potentially they would be proud of, or that they would want.
Absolutely. And intergenerationally, because how do I want to say? Because if the grandparents, let's say, house doesn't end up having to be sold once they've passed to be able to account for these debts, or again, like the legacy piece at the end of the day, the bigger picture that we're thinking here, we want the long-term care to be as beautiful and as individualized as it can be. And at the same time, because we're getting ready to go into these nuts and bolts on asset-based long-term care, it provides for the legacy piece. So I have some questions. If I can, let me run through some of these nuts and bolts tactical questions. Let's get some answers to the things that stick out to me and other people. and then perhaps we'll look at a case study, or we'll just go wherever you want to go. But I have some things from last time. So let me check some of these off of my list. Let's start with one of the simplest ones, I'm sure. How affordable is long-term care? So let's just approach, right, the money question for people, right? Let's do that one first. Often that can be a first question to premiums for whole life insurance. And I have a multifaceted way of looking at answering someone's question about premium, but you just begin to address that question and then we can go back and forth.
That's a question that, in all honesty, holds people back from getting a tool like this, the long-term care, is because we think that it's expensive. And it to me, I tell clients, it's like anything else. You're going to get ready to go buy a car. You're going to get ready to go buy a house. You're going to get ready to go, whatever, go to pay for your kids' college or whatever. You're going to budget that expense within your overall budget. And the reason you do that is because those things are important to you. And I say the same thing with these tools that we're putting in place, the whole life insurance, the long-term care piece, some people do annuities. Each one of these tools have a specific purpose, and built into these tools is the protection of your assets, your legacy in the future. And to me, the affordability question, I just tell clients, look, let's just work in your budget and let's identify really what I call pennies on the dollar to get this tool, because this tool is going to protect the years that you spent building this nest egg, this wealth accumulation that you've done over the years. Some of the sad things, I think, is that when people don't have this tool to at least it protect some, if not all, of their wealth building, uh, assets, what happens is that you'll spend, 20, 30, 40, 50 years building this, you know, pool, only to get to the place now that you need care. And now you have to spend down all that wealth to take care of yourself.
15 years of building something could be destroyed in 15 months of, just some short. Right.
It can. If you really look at what the cost of care is, the average cost right now, one statistic that I read is the average annual cost of full-time home health aid, just to kind of have somebody come in and, you're looking at about $61,000, almost $62,000 a year. How big of a nest egg do you have to be? Because, you're looking I think the average time span that a person could need care, I believe men, it's something like 2.5, almost 3 years. Women, it's a little bit longer, three and a half to 4 years. Um, you'd have to think about how much of a nest egg you would have to build up just to self-fund or self-cover yourself. Because by building up that nest egg, just to think about it from this perspective, you build up, let's say you build up, I don't know, I'm making up numbers, but like $1 million, of assets, $2 million, pick any number. but you don't have this tool in place, and now you need care. And so now you're going to have to spend down. Sure, you could, maybe be home and have somebody come in, and it'll be a little bit cheaper than if you had to go to maybe, an assisted living or skilled nursing facility. But in either case, you have to calculate like how long would that money have to last? And is there a possibility you might outlast it? And then what happens is now you basically, you know, burnt up all the money that you worked so hard, all the assets that you worked so hard to build, only to take it and to turn around and pay for, to take care of you. Now, if your goal of part of your goal, if your part of your goal of building it was for legacy purposes, well, there's no legacy to pass on now. Your children or your grandchildren now have to start over at ground zero, just like you did, and try to build up that wealth. So when we talk about affordability, I try to help people to understand that you're taking pennies to basically pay for a vehicle that's going to protect, you know, a numerous amounts of dollars that you built up over that time period. But kind of like what I said last time, start someplace. You may not necessarily get everything that you want when it comes to, the premium for the long-term care. Maybe you can't, your budget won't handle a policy that will, spit out $10,000 a month for you, when you need care. But maybe your budget can handle a policy that'll spit out $1,000 a month or $2,000 a month. And like I said, that in itself is going to be a help to not only protecting some of your assets, you won't have to spend down as much, or your assets can go a little bit further, but it also will help the people that are, assisting you or caring for you. It'll be a benefit to them as well. So affordability, how affordable is it? In my personal opinion, it's just as affordable as you figured out how to buy a house, or you figured out how to get a car, or you figured out how to go to college, or some of the big ticket things that we have in, our lives, we figure out how to budget for those things. In the same I would say for the long-term care piece. If you are a person, if your goal is that you just want to depend on the state and government help and support, you really don't need a long-term care policy. If that's your end goal, and that's okay. If that's your goal. If that's your goal, then you don't need a long-term care policy. Um, but you're going to be subjected to the limitations of what the government has to offer as well. And that you may or may not be, pleased with. But if your goal is that you want to have a certain lifestyle, um, in your, young years, as I like to call them, then, this is where you want to start to put this tool in place for you, and start where your budget can afford it.
Okay, so then that's what I'm gathering from you, and I appreciate you fleshing that out, that there's an entry point for everyone. It should just be what fits them, their budget, where they're at. Let me throw in some bullet points and you check me on any of these. It's safe to say that premiums at a younger age do more for people. Is that true? Right. So, of course, the earlier somebody starts, the better that it
Right.
is. right? The more coverage, so to speak, you'll get for less dollars because you are younger.
Exactly.
Okay. And then another generality that we could say, oh, let's see if I can hold on to it. What was it? There was another one, but let me go to this one. Another one that we might have mentioned, but let's underscore it again, is that you don't just have to have one long-term care policy, just like we don't necessarily encourage people to try and become your own banker by just getting one whole life policy for your financing needs. You could get a long-term care policy in your 30s or 40s or wherever you start at whatever age, and then maybe 5 years down the road, 2 years down the road, 10 years down the road, you stack another one on top of that. You add to your coverage, maybe because you're more capable, there's more wiggle room in the budget, your family's grown and you want to accommodate in a bigger way, your lifestyle has been raised and you don't want to see that diminish. So I've heard you use that word stacking. You could stack policies on top of each other, these long-term care policies. How am I doing so far?
You're doing great. That you're absolutely right.
Okay, and then of course I love the idea that the dollars that we do pay towards long-term care, they're covering more than that really at the end of the day, because they are providing the long-term care, but they're accomplishing the legacy goals that we have as well. And if we are stacking those, then we're setting ourselves up better and better and progressing and doing what Nelson described as building a private banking system with whole life policies for your financing needs. You are getting the dragons and the snakes out of your life and creating something private for yourself that's eventually going to become self-sustaining. And people can do that as well with long-term care. And I would point this out, Miss Robin, if somebody leads the way in the family by procuring long-term care for the generation above them, if they can, because they'll be the next in line to receive whatever legacy, and they'll be the ones in the position of doing the care and everything that we talked about last time, that will begin creating another layer to a self-creating or a self-sufficient family dynasty, like you like to use that word, because now not only we're accounting for our need of finance in general, broadly, but particularly to include long-term care. Does that make sense? Meaning that once that first generation experiences the utility and then the legacy piece of long-term care policies, the next generation is starting from a very different position. And if you have long-term care policies, a system of long-term care policies on top of whole life policies for your need of finance, it's incredible. It's incredible.
Yeah, I was just thinking, you're absolutely right, because it makes me think about, again, my own personal situation. And with my mom, I don't know if I mentioned it last time, but my mom never experienced having to care for someone. She herself was the youngest, next to the youngest sibling, in her family, and her mom and her dad died, when she was a teenager. So she never had that experience. So for me, I never got to see what it was to care for someone. My mom, I never saw my mom, or my dad, have to do, this level of caring for someone. So even in my family, I'm the first, my sister and I are the first in that caregiving space. But my boys are watching what they see their mom and dad have to do to take care of their grandmother, at this time. So I can see for myself, just me being in this space has made long-term care even more important, because I understand, from a personal experience, the sacrifices that me and my sister have had to make, in order to care for my mom. My mom, on the other hand, she's never been in this space, so she doesn't quite she sees it from her going through it personally, but she doesn't see my side of it, as clearly. She gets an idea, but she doesn't understand, the toll or the sacrifice that, my sister and I have had to make in order to care for her. In my experience, and even in my sister's experience, we get to talk to our children to tell them what it is that we're experiencing. So they have a better understanding. So my sister's kids aren't in yet in the age level where they could get this tool for themselves, but it has sparked the conversation with my sister and her kids and them discussing like, okay, hey, mom, dad, when you guys get to this. And for my husband and I, we have our have a long-term care policy. And but I've been able to talk with my boys because they're just coming into that age now where they can start to consider this tool for themselves. And it's an easier conversation because they're watching it, they're on the outside kind of watching what it is that we are going, my sister and I are going through, so they have an idea. And as I've been communicating with them, because that is my next goal, is for them to at least start to get, even if it's just a small policy at their age, um and to start coming into that understanding of how powerful this tool is going to be to protect, you know, they're surpassing, my husband and I financially, just with their jobs and their ability. So their ability to build even more assets than even what my husband and I have done is there. So this tool becomes even more important, for them to start putting into place. So just kind of, again, using my personal experience, my mom, who had not a clue, who's never been in this space before. Me and my sister now, this is our first time being in this space and never had the opportunity to watch, you know, our parents do it. And then to see our children having, so to speak, the bird's eye view of watching their moms having to go through this, and the conversation, having being able to begin that conversation with them. To me, that's really powerful. And then to your point, long-term care, this tool becomes an easier conversation to have, and it becomes more real, for my sister and I that are going through it, and then the kids that are kind of watching it all.
Well, anything that facilitates broader family conversations, I love, because the more aware we are, the better we can do. I feel like the more communication we have, the better we can do. So I love that aspect of it. You brought up another question that I don't even think I had written down in my notes, but maybe I did. How about age? Who is long term care for? And so, broadly speaking, generally speaking, because we work with multiple companies, and of course, people should be having, ultimately, let me say this, ultimately, people should be having a private one on one conversation about their goals, their plans, their cash flows, etc., just like we would for anything with infinite banking. You should have a one-on-one conversation, or at least I say that. I don't have a cookie cutter approach to working with people, so we should be having conversations. But what are the ages? Is there a minimum age in general where someone's probably not even eligible, and then same thing, is there somebody who's too old to go ahead and procure long-term care for themselves or for a parent or family member?
Right. Yeah. So the company that I like, that I work with, their minimum age is 35. Okay. 35 is the soonest that a person could get a long-term care policy. The upper age is going to be about 80. Um, and the key that's going to come into play, of course, just like insurance, because I mentioned the type of long-term care that I'm more partial to, and that is the asset-based long-term care type of policy. And the asset-based long-term care type of policy is basically a whole life product. I always say it's a whole life chassis with, a long-term care built into it. So the whole life, like whole life insurance, your health is going to play a factor. So again, another reason why, getting this tool sooner rather than later is going to be important, is because your health is going to play part. Typically in our society, as we get older, the body starts to knock and ping and ting and different things like that. So, you know, as you get older, there might be health issues that may prevent you from getting this tool. You may want it, but if your health is such that, though the underwriting for a long-term care policy is a little bit more lenient than getting a whole life insurance, the underwriting for a whole life insurance policy, your health is still going to play some factor. And so if you may want this tool, but if you wait, you know, until later in your age, you may find that your health may not allow you to get this tool. So 35 is the earliest. The sweet spot, I think, more like 50, 60. Area is kind of the sweet spot of where, people will go, okay, yeah, I definitely, want to do this. Um, so to me, the sooner, today is the best day. If you can sit down with someone, talk with them, start putting a plan together today, that's going to be your best day. That's going to be, the least in terms of the price of the premium.
Okay, good. Very helpful. So far we're at the affordability is pennies on the dollar. Who's it for? 35 to 80. Of course, remembering stacking, somebody could get their first policy as soon as they're 35 to have some base layer of coverage, right? Now, how about the functionality of these types of contracts? So these types of contracts are going to have a regular level premium, right? Meaning like somebody's going to probably pay something monthly, quarterly, semi-annually, meaning twice a year, or annually on the premium side of things, right? And it would provide for them a certain death benefit because of the whole life policy chassis. There's going to be a death benefit if you're using an asset-based type, which I prefer as well. And then based on that premium and their age and what their contract says, they're going to be eligible for a certain amount of distribution each month to facilitate that long-term care. Okay, so far so good. Anything you'd add to that right there?
Yeah, the beauty about this particular company that I like, they have multiple ways that you can fund your asset care policy. So to your point, you can pay, reoccurring premiums, monthly, quarterly, semi-annually, annually. You can do a single pay premium. So if you want to just, hey, I just want to make one payment and be done, there's that option as well. If you wanted to use qualified money. If you wanted to use your IRA, or you wanted to use your 401k, monies can come that way as well. So, one of the reasons that I really like this company and their particular product is because of the flexibility. You can design it to fit you know, what works for you. You can choose the number of years that, you want to, pay. Maybe you only want to pay premiums for 5 years, 10 years, 20 years and be done. You have that option as well. So there's like I think I said it last time, there's uh, several little dials that you can tweak to fit your particular situation, your goals, your budget. And going back to what you said, and you can stack it, if you want to get a smaller long-term care policy premium. And then, a couple of years down the road, you want to add another one on top of that, you most certainly can do that as well. So it's a very flexible, and that I think that's what I like about it, is because you can design it to the person, whatever it is that they're looking for. And what I design for one person is going to be different, for another person. So, and the premiums stay locked in. They're guaranteed never to go up. So whatever you pay today, if you don't go on can't claim for another 20, 30 years, that's, the premiums will never go up. You're guaranteed a monthly benefit, so whenever you do go on claim, then that tool is going to start spitting out the dollars to, support you to take care of whatever your needs are at that time. So you're guaranteed to have that. You're guaranteed to have a cash value growth in that tool. So if, you know, 10 years from now, something happens and you need access to money for some reason, this tool will have it. I still say to my clients, the cash value is going to be inside that tool. And yes, you can access it, use it for whatever you need to use it for, but let it be the tool of last resort that you go to for cash. Because the purpose that you got this tool in the first place was for long-term care. And if you start, dipping into that cash value, you're going to affect, the monthly benefit on the other side. So, but it's there. If I have an emergency and I need to get access to cash, then that's the place that it'll be. And then the other, benefit of it is if I never need it, if I never use it for long-term care, then I've got a guaranteed death benefit that will be paid out to the heirs. So there's a lot of guarantees that is built into this tool, which for me gives me comfort and peace of mind. I say it's the tool you can't lose. There's no way for you to lose on this tool. You just pay your premium and you figure that out, what budget you want to pay, but you just pay the premium because it's a contract between you and the insurance company. You pay the premium and they promise to do, to uphold their end of the bargain. But as long as I pay that premium, that contract is going to work. And whatever life throws at me, if I go on claim, if I go on care, that tool is going to spit out the dollars to help me. If I never use it for care, that tool is going to spit out the dollars to my heirs as a death benefit. So that's the way I think about it, Jesse, is I can't lose.
So let me ask a couple of clarifying questions then. So the death benefit at the end of the day is just like death benefit from a whole life contract in that, estate laws, apply. Of course, everybody should be working with all their necessary professionals, but it's an income tax-free windfall to the next generation being a death benefit from an insurance company. Beautiful. Just I'm just saying it's another highlight. It's just another thing, right? That shows the virtue of these types of contracts. And then also, I understand that it's just in the need of, emergency access to capital, let's say, when we might would collateralize or leverage the cash value of these types of contracts as well. So let's say somebody's not implementing infinite banking, because I believe long-term care stands on its own 2 feet. If people are out there doing their conventional approach to finance, but they see the virtue of long-term care and they want to get it from these great mutual companies, great. But at the end of the day, like you're saying, in the event of an emergency, where you have tapped into your emergency fund that you have at home or in the savings account or whatever, and you have done this, and maybe you don't want to liquidate other things that are going to have tax repercussions, maybe you do choose to leverage this private contract, in that event, then you refill that back because you didn't want to, bite the bullet on some taxes, let's say from investments that you didn't want to touch just yet. Does that make sense? I mean, I just see all different kinds of scenarios where all of the advantages are on the or are held by the individual who owns the contract. Tax-free access to capital in the event of an emergency, and income-free tax windfall to the next generation, and then of course the long-term care the whole time when they need it.
Yeah, and let me just, I want to make it clear to, to the audience, there's a death benefit with this tool if I don't use it for care. Okay, so I just want to, because what is happening when I go on claim, and I'll kind of maybe talk about what does it mean. I keep saying that word, go on claim. When I go on claim, I'm going to spin down the death benefit first. Okay. The other feature or the other dial that you can add to this long-term care, asset-based long-term care tool is what's called a lifetime rider. Okay. A continuation, they call it a continuation of benefits rider. That particular rider then basically says if you go on claim and you spin down that death benefit pool, okay, because that's the first thing that is going to be spent down, if you will, by paying out the monthly benefit to you. Then if you have this rider on, it's going to continue to pay that benefit until you die. So you can't outlive it. Okay. So I always just make sure that my clients understand, don't get the long-term care because it has the death benefit to it, thinking, well, this is my insurance policy because if I die, there will be a death benefit. It is if you don't go on claim. Okay. If you have to use it for care, then the death benefit is going to be spent down to cover your care. And it's possible you might spend it all up before you die, and then there's no death benefit to to send to your heirs, so to speak. So I always say, life insurance policy, you want that tool. You need to understand, I'm not in construction, but I feel like I missed my calling because I should have been in construction. Um, but I think about it from, in construction, there's a tool for everything. You've got a hammer to do one job, you got a saw to do another job, you got, whatever. You got all these different tools. You got a screwdriver. You got these different tools, and each tool, has a purpose. And if you use it for the purpose, you'll get great results. But if I try to take, a screwdriver and make it into a hammer, I'm not going to get as good a result as if I just got the hammer. And it's the same thing. The life insurance, if we want a death benefit, get a life insurance policy. If you want long-term care, get the long-term care policy. The cherry on top is, and the hope is you'll never need care. You will never go, you will just go peacefully in your sleep. And, yesterday you were out at 90 years old and working in your garden, and then the next day you just went home. and, you just went home peacefully in your sleep, and we never initiated that long-term care. The cherry on top is, oh, I've got another death benefit that's going to get passed out to the heirs. So, I just like to clarify with, because I actually have, one of my prospects that I was talking with, he didn't have life insurance. He doesn't have life insurance. And that's all he kept focusing on was, oh, well, there's a death benefit to the long term. We were talking about long-term care. And he said, oh, okay, well, there's a death benefit with the long-term care. And I had to kind of keep reiterating to him, understand that if you do go on claim, you're going to spend down this death benefit, and it's possible you will use it all up. Now, if you don't use it all up, then whatever's left will be passed on to your heirs. But nobody has a crystal ball. You don't know what, you know, tomorrow's going to hold. I told you my story of my mother-in-law who came to live with us at age 100, and she lived another 8 years. Um, you know, somebody, and in her particular case, she was able to dress herself, bathe herself. She probably would have been able to activate, if she didn't have one, but if she did have a long-term care policy, she would have been able to, activate that policy because, her eyes were dim, her ears were dull, so she could use, the support and the help. But she lived a long time, and even if I said that let's just say she had a long-term care policy, and at age 100 she activated her policy, she lived another 8 years. So she would have spent down, potentially spent down whatever death benefit if she had this particular tool that, that because she would have lived a long time on claim. And it is very possible that people can live a long time on claim, with their long-term care. So I just like to just kind of make sure that, people understand there is a death benefit, but that's the cherry on top. That's not something you want to get instead of getting, a whole life insurance policy, which is that a death benefit.
So I'm tracking with what you're saying exactly. If somebody's wanting or needing insurance, okay, and for me it's going to be whole, properly structured whole life policies or convertible term or a mixture of those two, then they should do that first. We all have a need of finance, but here's where I want to go with this point, Ms. Robin. That's one of my questions from last time. We have a need of finance. We encourage people to get whole life policies and then also convertible term policies that they'll be able to convert later on to more whole life policies for their need of finance. We're here encouraging folks to consider long-term care policies that are designed as a contract to provide for long-term care. They're not a replacement for whole life insurance at face value, let alone whole life insurance that's designed for utilization to implement infinite banking. So since we're asking folks to consider both of these things, what would you then say to the person, let's say, maybe they've been doing infinite banking for a year or two, and they're hearing about, because I know there are going to be lots of my clients and other folks that are going to come across this information, yours too, and I want them to have this answer. What if they've been doing infinite banking for a year or two, and they're thinking, well, but Jesse, I thought that my private banking system was to provide for my need of finance, and wouldn't that include things later in life like passive income, long-term care, legacy, a lot of the things that we're talking about. Now I have my answer, but I'm putting it to you first, right? So what do you think about that?
That's a good question. And what comes to my mind, I haven't had anybody ask me that. Um, but what comes to my mind, I think about, like I said, I don't know if we really comprehend the cost of care. What is it going to cost for someone, to be on in, on claim for, let's say, 3 years, 4 years? The question is, you'd have to, number one, you'd have to build up your banking system to cover that cost, and then to be able to pass on a legacy as well. And because you don't know how long you're going to live, I think you're playing Russian roulette to try to go, okay, no, just let me get, my banking policy, and let me just build up my banking policy. And I'm going to use my banking policy to take care of me in retirement, because you're not playing, until you're later in life, right? But you may retire, at some point, or you may transition from, what you had to do to now what you like to do. And so, people get their banking policies for their retirement. They're going to build for their retirement. So you're going to use this one tool to take care of your retirement, to take care of all your financing needs, and now you want this one tool to also cover your possible long-term care needs. I think you're putting a lot of pressure on one tool. To me, that's just my personal opinion. Um, me personally, I want to have my banking policy to cover my financing needs, and to cover, potentially my retirement needs. And I want a whole separate tool that's not attached to, this tool, that also my hope is that I leave a legacy with this tool, with this banking tool. I don't want my long-term care tool, because the cost is, in my opinion, the costs are going to be astronomical, especially as we go in the future. Remind me, Jesse, I don't know if you've seen the interactive map, the long-term care tool interactive map. If you haven't, remind me to send that to you, because for me, I think it's an eye-opener, game changer, because it really shows you the cost of potentially what it's going to be currently today, as well as, 10, 20, 30 years down the road, what it might look like. So I think if one is trying to do everything with their banking policy, I don't know, my personal opinion, and I could be wrong, but my personal opinion is that I feel like you're putting a lot of pressure on that one tool. And the long-term care is not something that I would want to gamble with, but I'm not a gambler.
Let me ask this. Because people who are familiar with whole life insurance and how it can be designed for infinite banking, you mentioned riders earlier, like a lifetime rider. Okay, so people could have, a policy where it provides 10 years of coverage for them, right? Just for an example, a set period of time that it would provide coverage for them, okay, based on what kind of contract they chose. And then there could be this lifetime rider as well. So let me also do this while I ask this question. When folks are taking a distribution, is it okay for me to use that word distribution? Everybody knows what I'm saying. You're receiving the benefit of your policy, your long-term care policy. That comes from the death benefit. So whatever's not used is what passes as a death benefit to the next generation, income tax-free.
Right.
Just trying to underscore that because you said it earlier. Let's say it again. That's important to recognize because that's how the policy works. The long-term care policy contract works that way. Are there any other riders in general that we should mention here?
Oh yeah, there's inflation rider, so because you're buying this tool today, you may not activate this tool for another 20, 30, 40, you're 40 years old. Is that,
I'm 40.
oh yeah. So let's say you don't activate this tool for another 40, 45, 50 years. Okay. The cost is going to go considerably high over that time period. So you can actually add what's called an inflation rider, which will, of course, there's it increases the premium, because you're paying for that ability that the monthly benefit, will increase, over the year. So
Yes, the consumer pays for everything.
right, right, you've got to pay for that benefit as well.
And I mean that in a way that it's worthwhile. I'm not trying to talk at the same time as you, Miss Robin. I didn't mean that in a derogatory way either. Like you get what you pay for kind of thing. I think people would understand it if I said it better like that. You get what you pay for. These are worthwhile things to consider adding as riders to a long-term care policy.
Exactly, exactly. So, and again, it's a choice. Like I said, you got all these dials, and you can, somebody might add an inflation. One person might add an inflation rider to their overall plan. Another person may not. It's totally up to them. You have a return of premium rider. That if somewhere down the road you decide, hey, I don't want this, or don't want to uh, use it for the purpose that I purchased it for, or whatever. You can, again, your premium's gonna be a little bit more, but you can add um that benefit on to it as well. Trying to think of what other, there's a couple of other benefits.
And I was trying to keep it generic. I mean, you don't have to get too specific if you don't want to. There's an option to cover more than one person at the same time too, right? Like you could get two people covered, let's say.
Right, you can get two people covered. So again, the particular company that I lean towards, they have a joint policy, where you, with one policy, you can cover two lives.
Right. So all that to say again, the importance of having a one-on-one conversation with somebody who can build what you want and what you should have. And you did remind me, Miss Robin, by talking about that inflation rider, for example. That's the one thing that I was trying to think about how to underscore or rephrase earlier, which is if somebody's built a system of whole life policies for their need of finance, they've privatized their banking, right? I'm always encouraging people to grow and scale that system because we don't know ahead what taxation is going to look like, what inflation is going to look like, what our family needs are. I mean, our families are going to grow. Our need of finance is never going to diminish. We're never going to want to intentionally take a step down in lifestyle. We'd rather not, right? So like everything seems like it will go up in the future. So if we're going to have that mindset when building our private banking system, of course we should have that mindset for building long-term care coverage for ourselves because yeah, who knows what the cost is going to be for X, Y, or Z now. And I use this example often with folks, right? What did a candy bar cost 50 years ago? What did it cost only 5 years ago? What might it cost 5 years from now? 50 years from now? Okay, so let's just extrapolate that out to long-term care. And if there's a significant need of capital today, if you needed long-term care today, what's it going to be decades from now? Who knows? So that's what I was wanting to underscore. Beautiful.
I like to, for me, I remember gas, and I remember in college, and when I, got my car and I went to go fill up, at that time it was 50 cents a gallon, of gas. Today, well, at least out here in Florida, we're about, I think, 280, 290, and so gas is something that, is for my generation, it's easy for us to correlate, and the thing that I kind of help people to understand is you got to recognize or realize that the dollar today is not going to buy the same amount that it will in the future, because our dollar, in reality, our dollar is eroding. So, you have to understand that that is one of the purposes for the inflation rider, is to kind of compensate for the higher cost of things in the future.
So that college example of what a gas cost is so good, Miss Robin, because it automatically made me think of where Nelson, in his Becoming Your Own Baker book, talks about an example where things went 5x. So how interesting that you talk about 50 cent a gallon to roughly 5 times that amount today, right? So what might gas cost 50 years from now, or whatever the number is, $15. Now, when we say that and think that it could cost us a couple $100 or whatever that is going to be to fill $300 to fill up, a tank of gas, are you kidding me? But it's happened. We can't balk at that. We can't ignore, we shouldn't ignore what history shows us over and over and over again, that this inflated money supply that's out of our control, at the me and you level anyway, we can't push a button and change that, okay? If it 5x'd in the past, is it likely to 5x again now moving forward? Yes, the answer is yes. So we should prepare for that. We should be proactive about it. So just interesting how that math plays out, that history plays out. How about anything from the application process, Miss Robin? We might have hit that, but I have it as a question mark and I don't have anything written down beside it. So describe in general what an application process looks like, or what an onboarding process with you even looks like in general for somebody who's interested in having a conversation with you about long-term care and going through the process to get a policy.
Basically, a person says, "Hey, Robin, okay, I'm ready to go." Typically, we've kind of talked about, some of the dials, some of the, okay, do you think you would want an inflation rider? Do you think you want to pay, you know, for your life until you go on claim? Do you want to pay premiums for 5 years, 10 years? What does that look like? Typically we're going to run, a couple of different scenarios to see, what works in the budget or whatever. And then once they decide that, okay, yes, this is the particular plan that I want, then I'm usually going to ask them a few health things, because there are some things that are going to be no, to the insurance company, like, if you currently have cancer, or if you had cancer in whatever, in the last 2 years, then it's going to be an automatic no. So prior to, I'm going to try to get some idea of health wise, to see if there's anything that you might be dealing with that either would be an automatic no, I'm sorry, the insurance company is not going to, extend an offer to you. Or if it's going to be one that I may not know 100%. And so if there might be a couple of questions health wise, and I just had this with a couple, with the wife, there was a couple of things that it didn't quite fit in, the list of no's, but there's something that we can do where we can send an inquiry to the underwriter and they will, kind of, we give them all the details that we can as kind of a pre-application or pre-underwriting, to get an idea like, would you consider this person for underwriting? And then from there, it's gonna be easy. Just doing the application. Name, social security, pay, phone number, address. Just and putting in all the different dial levers that we selected basically, and then it's gonna go to the underwriting. And it will go through its underwriting process, and then the company will, either come back and say, okay, great, here's an offer, and then, we'll go over it, make sure that everything is what you want. And then if it is, you'll sign it, pay the premium, and, the policy is going to be enforced. The other side of it is the insurance. I think I've had one person. I think I've had one person where, we went through the underwriting process, but it ended up that just some health issues they were dealing with, the insurance company just said no. Because you have to understand, insurance company is taking on a risk. They're going to have to pay out thousands of dollars, so they're going to be very careful in assessing, the risk. Now, with this particular company that that I like to lean towards, they not only have the long-term care with with the whole life chassis, but they have the asset care with an annuity chassis. And that one, the underwriting would be a little bit more lenient than the long-term care with the whole life chassis. So, it is possible that if and the insurance company will could come back and say, hey, we won't do the asset base, the whole life product, but we would consider the annuity product if your client wants to do that. So it's the underwriting is not hard. There is, I believe it's 65 and over, there's going to be a cognitive interview, step in there. I think it's 65. Don't hold me to it, but I believe it's 65. There's a cognitive interview.
Right. And I won't hold you to that because other companies might have a different metric, but that brings up a really good point because when we've talked about long-term care in our conversation so far, we've not made a real pointed example out of, dementia, Alzheimer, any of the cognitive issues where folks, so people don't think about that because, when you're in your right mind, we're just out here living life, but there are needs beyond the physical. They could be cognitive impairments or cognitive, diseases that folks deal with where long-term care helps out in more than one way.
Exactly. That is one of okay, maybe I should, that kind of leads me to, I've mentioned several times, what does it mean to go on claim? And basically there's two ways that one can go on claim.
Can I jump in real quick? Real quick. I did just want to underscore for folks that are ready to have the conversation or considering having the conversation, have the conversation. Like we did not just give out a full comprehensive list. So, well, if you had this, you have that. If you're interested in long-term care, let's have a conversation. We'll find out. We'll let the insurance company tell us if you're not eligible. Okay, we're not going to do that over here. We're just facilitating the conversation around long-term care. You need to have a one-on-one conversation with your advisor, your agent, the person that you're working with when it comes to that. Okay, so then because you have mentioned it, Miss Robin, tell us about what it does look like, what triggers that.
For one to go on claim.
Activating, going on claim. That's the phrase. Thank you. That's what I was trying to recall.
Yeah, so one of two ways. And one is that you aren't able to do what they call two of the six ADLs, or activities of daily living, so you can't dress yourself or bathe yourself or, transfer, or you have continence problems. Anything, I always say, think of a baby, all the stuff you had to do to help a baby. If you have to feed a baby, you have to change the diaper of a baby, you have to bathe a baby. If you can't do two out of the six, then that will activate your long-term care. And of course, it's got to be doctor uh, proven or whatever. The other way is going to be cognitive, so if you're, maybe dealing with dementia or, Alzheimer's, that will be another thing that can activate your long-term care policy. So if either one of those two, things happen, then your policy will activate, and if you were paying premiums on it, the premiums would stop and this policy will start to, support you, however you want. So again, another decision is, where might you have your care? Will it be at home, with family members and friends? Would you be going to an assisted living facility? Would you need a skilled nursing? Maybe you might be going to an adult daycare, and it really doesn't matter. Your long-term care policy is going to support you whichever pathway
Right.
that you take.
I love that. Okay, and I do remember my other question because it was in the application process where you said the insurance company may come back and say, well, okay, you don't qualify for the chassis with the whole life insurance, but the annuity. So could you give me a quick description on that annuity based?
Yeah, the annuity, the uh, and I personally have not done, I don't think I've done anybody with the annuity base. But it actually, it acts kind of like, an annuity, where money is going to be dumped into an annuity chassis, and then from that annuity, kind of like annuity is going to pay out, but that annuity is going to pay the long-term care premium, so to speak, for for whenever you're going to need it. I do know that the underwriting can be a little bit more lenient than uh, the whole life chassis. So pretty much it acts the same way as a whole life. The premiums are going to be paid for. You can dial it similar to, the whole life chassis, and it's going to pay out the monthly benefit just like it would, with the whole life chassis. So, but it just uses an annuity instead of a whole life.
Right. And I'm glad you brought that up because for everybody that's listening, and an annuity is another type of contract from these insurance companies. I've actually recorded, and Miss Robin, you know Joseph DeFazio, our friend. I've actually recorded a two-part installation on annuities. So if you've not seen that, by the time that you're seeing this video, you can go see Joe and I talk about annuities on the channel. Make sure to check that out. Yeah. Do you have something else you're wanting to?
I was just going to kind of give I've got a few notes of, just little bullet points. So I'll just
Please.
kind of wrap it up with a quick thing. Again, just to kind of reiterate, like, what is long-term care? And I even wrote down long-term care is intended to provide support to those who need assistance due to what we just talked about, severe cognitive impairment, or need help in completing activities of daily living. And just to reiterate, activities of daily living are just like eating or bathing or, dressing yourself or transferring yourself or continence, toileting, any of those, if you can't do two out of the six. Your care that support can be given at home. It can be given, at skilled nursing facility, assisted living, adult daycare. So, however you want that care to be, it can be. But why should one look at long-term care? The thing that I want to encourage people is the statistic is 70% of the people today are turning 65. As a matter of fact, in September, I will turn 65. And so that statement is true. 70% of the people are turning 65 and will eventually need some form of long-term care. That's statistics. And the question is, how do you control or maintain that care? That's the encouragement for people to think about. How do you want to control that care, and how do you want to maintain your independence, and preserve your assets? Ultimately, you're working hard to build. How do you protect what you build, what you built? Um, Statistic, 20% of the people will require care for 5 years or longer. 20% of the people will require care for 5 years or longer. And I kind of mentioned earlier that the average annual cost of full-time, just having an aide come into the home, you're looking right now, the average today is about $62,000 a year. And that statistically, right now, and I'm part of this particular statistic, 80% of the long-term care is provided by family members. 80%. So when I say and encourage, especially my generation, but also, I encourage people even of your age, Jesse, because the key is we kind of, I want us to be careful not to think of long-term care just for seniors, because accidents happen. And as a matter of fact, there's a young man that where I take my mom to go for her wound care. I'm gonna say this young man is probably, I think he said he was like 40, 44. Is 44 years old. He is permanently in his wheelchair. And what he told me, as a matter of fact, he told me this today because we happened to be at the wound care together today. And he told me that he broke his neck and diving he was 16 years old. And he said that he jumped off, some, I don't know, some ridge or something. And he said he's jumped off this ridge. He said he had jumped off that ridge 3 times prior to this accident happened in the same day. He said his shoulder was kind of hurting, so he had taken a break. And then, after he said about 45 minutes, he went to go jump the same place that he had just jumped previously into the water. But he said something about the tide had, I guess the tide had moved. And this time he said he didn't notice there was a barge, just in the water, but he never saw it previously before. This time he said when he jumped off, he hit head first into the barge, and he said it pushed it. He said his head was on his back, basically. And this is a young man that now is forever going to be in his wheelchair. And he's the sweetest young man, and we've just gotten to know him over the years because he's at the same wound care place that my mom is at. And my heart goes out to him, because his life forever at that moment, that time period was forever altered. And he's a type of person that if he has a lot, and I don't know, I didn't even ask him, but if he has a long-term care policy, that long-term care policy is going to potentially this he said happened when he was 16 and he's now 44. So you can see how long a person can be on claim and can be on claim at a young age. So, my encouragement, I want to encourage people, don't think of long-term care as just the old people's product, so to speak. Think of it as a asset protection product. And if you're going to be building assets, then this is a tool to, so to speak, put a moat around those assets that you're building for whatever life might throw at you. So, so that's why I say, who should get a long-term care plan, honestly, it, starting at 35, I would start thinking about it, getting it. And, just think of it from the standpoint that you're building a moat around your asset building uh, work efforts that you're building over the years. So those are just a couple of things that I wanted to share.
I love your language. Castle, moat, asset, protection. That's my kind of language, Miss Robin. Well, I can't say thank you enough, of course, for sharing your personal experience, but also your professional perspective as well. It's been very helpful for me to chat this out, talk through this, have these examples, get my questions answered, and do it in a way where I know that folks are going to be able to benefit from it. So again, if you consider yourself your greatest asset, I certainly do, put that moat around you. Make it how you want it to be. Of course, Miss Robin's contact information will be in the show notes below, as always. You can find me at durhamtalents.com. In the best of scenarios, I see this long-term care as a way for us all to be able to live and leave a lasting legacy. So that's why I'm bringing this conversation to you, and I look forward to picking up where we can best help you next. Do live and leave a lasting legacy. Have a great day. Take care.